a look at what the jobless claims and the GDP report provided this morning.
Meantime, we are now just seconds away from jobless claims and getting the latest GDP data. I want to get over to our good friend in Chicago. Rick Santelli is standing by. Ahead of that, you got the Dow up about 40 points. All this could move around, though. You got NASDAQ off this morning. Rick, what should we be watching? What are you thinking about?
Well, I'll tell you, I think a lot of attention being paid to issues that I don't pay a lot of attention to. I'm a market guy. All the talk about what's going on in the Fed, once it starts to move the markets, it's something that I think I'll pay more attention to. Right now, I think for many, it's a distraction, as many of the indices are near or at record highs. Interest rates certainly haven't paid attention to some of the issues. And believe me, it's something I've never seen, the interaction between the Fed and the administration. It's something interesting. I'm sure it'll be in the history books. But until it's market moving, I continue to monitor things that are coming out in about 18 seconds. Our second walk around the block on GDP will underscore the tug of war in the economy between quarters that are weak and quarters that are strong, import, exports, tariffs. We have a lot of push and pull based on some of the issues of the day. We are expecting this number to improve slightly, and the revisions, our second look at second quarter GDP, are now hitting the wires. 3% was our last look. It now jumps up to 3.3%. But from a comp basis, that would still be the best quarter since September of 23, third quarter of 23. Consumption, always important in a consumption economy. It remains strong. 1.4, our first look. 1.6, our modified look. 1.6 will be the best consumption since the last quarter of 24, when it was well above. It was at 4%. Now, the pricing index, maybe this has more relevance considering all the issues of the day the press is on with the Fed. Well, it remains at 2%. No changes there. How does 2% stack up? Well, 3.8% was the last first quarter of 25. The last quarter of 24 was 2.3. That pretty much gives you some good insight. And finally, let's look at the core side of the equation on the price index. 2.5, so it remains exactly at 2.5. No change there. The first quarter was 3.5. The third quarter of 24 was 2.2. Initial jobless claims have been awfully well behaved. Nothing changes there, Andrew. 229,000 from a slightly modified 235 that turns into 234. Now we subtract 5,000 and up at 229,000. 229,000 once again just dovetails right in. I think the most important issue is we have 250,000 right on the nose on the first week in June. You have to go to October of last year to find a number above 250,000. So it's hard for me to get worried about this. And if this is considered the best real-time evaluation of the labor market, there's no issues that it's sending. It's not sending any smoke signals. Obviously, we've seen slowdowns in other areas, and there's lots of anecdotal evidence. Continuing claims, 1,954,000, another number that's stacked in there. Basically, all these numbers comp back to November of 2021. That's the last time we've seen numbers higher than this. Interest rates really haven't moved much. 4.23 and a 10 is minus 1 basis point. 3.63 and the 2-year is unchanged. Actually, I take that back. That is up 2. We closed at 361 on the late close in the cash market. We want to continue to monitor the stories about the Fed, the stories about Cook, and then look at things like what's the percentage of the market and a quarter point cut for September. It's still in the 85%. It's hardly flinched while all the press is going hog wild over these stories. Back to you.
So I'm going to go back to a screen right here. Let's take a look at the initial jobless claims. And before we get there, let's go to GDP. We're going to start with GDP. All right. So GDP was 3.3%. Again, look at the numbers down in the red. We got 3.3% versus what was estimated, which was 3.1%. So the GDP for the United States for the second quarter read higher than the expected rate, which means that the economy is doing really well. The American economy, from the report, from the GDP report, is doing really good. Now, all of this matters to the Fed, because these are the reports the Fed are taking and ultimately evaluating when it comes to if they should lower interest rates or not, which affects everyday folks like you and me, right? So we have better than expected economy, and if we go down to the initial jobless claims, which means that the claims for people that are basically saying that they don't have a job, they're filing for unemployment, doing things like that, are 229,000 versus the estimated 230,000. Now, that might not seem as a huge number when it comes to, what the estimated, guide we thought was going to be versus the actual report, but it basically states that less people, are said that they're going to be unemployed or are initially unemployed than expected. Why does that matter? If you pay attention to last week, Jackson Hole, which is the meeting that the federal chair had, one of the things he said in Jackson Hole was he was concerned initially by the most previous unemployment report that went up a little bit, which means that the market took that as cutting interest rates in September, as the gentleman stated, was at an 85% chance based on the Fed's mandate of lower inflation and low unemployment. If the Fed decides that unemployment is going up, there will lower interest rates, right? As well as keeping inflation, under control. If unemployment is not an issue and you have higher inflation, then there will be no rate cuts. And the high interest rate environment that we've seen over the last, few years ultimately is just going to stay higher. So it's important for us to know these data points, to take a look at the details, to understand how that then impacts the stock market. If the market is projecting a 25 basis point cut in September, which is then projecting about one or two more cuts before the end of this year, then the stock market will react in a positive way if there's a rate cut in September, and really negatively if there's not a rate cut. So as an investor, it's important for you to know the details of these reports, as well as forecasts what the market is going to do, and ultimately what the Fed chair is ultimately going to do when it comes to cutting interest rates. That impacts everybody. It impacts you when it comes to getting loans from banks. It impacts you when it comes to buying houses, when it comes to mortgages, as well as businesses doing business when it comes to percentage rates when it comes to loans.